Hi, Randy Katz here. Last time we started touching on a couple balance sheet topics. So we're going to explore the balance sheet a little further today with a discussion about working capital. And I believe that working capital is one of the most misunderstood parts of a business transaction. And for small business owners, probably one of the most misunderstood issues of operating a business. Now, the definition of working capital is current assets minus current liabilities. However, for this discussion, we're more interested in the cash conversion cycle. So think about it this way. If I'm a distribution company, I'm going to take my cash and buy inventory. I've now turned it into inventory and accounts payable. I then sell my inventory and I turn it into accounts receivable, at which point I collect on my AR, I pay off my AP, and I end up with cash again. How long does that take me? Can I afford to pay my rent and my employees while I wait for the cash to arrive? If I have my cash tied up for a long time, I can be insolvent even in scenarios where my sales are robust or even growing. Hopefully you can get a sense of why having a keen eye on your balance sheet is extremely important and not just looking at your profit and loss statement. And if you don't have an accounting system that properly tracks your sales and expense through the full cycle from order to payment, it's impossible to know the true working capital needs of your business. It's further complicated because even if your accounting system is set up correctly, your working capital can move quite a bit based upon your failure to collect AR in a timely manner or your eagerness to pay off your AP without utilizing the terms that your vendors offer you. Aside from the challenges in analyzing working capital, it gets even more confusing in a business transaction if not handled appropriately. Let's assume your business needs $1 million of working capital. You receive an offer for $5 million, and it's not explicitly defined if the working capital is included or if the buyer is bringing their own. One party of this transaction is going to be really surprised when this deal gets ironed out later, and you've got a deal-killing event on your hands. What I will tell our sellers is if you're selling a turnkey entity, a buyer is going to assume that working capital is included in the deal. With this idea in mind, there's huge value in implementing tight inventory controls, reduce the amount of obsolete or slow-moving inventory, aggressively collecting on your AR in a timely manner, or utilizing the vendor terms that are offered to you. If you're able to reduce the cash tied up in your business, you're going to end up with far more in your pocket, both now and in a sale.